Ind AS 10 Events after the reporting period. Definition of events after the reporting period. These are favorable and unfavorable events that occur between the end of reporting period, that is balance sheet date, and the date when financial statements are approved by board of directors or some specific authority. Here, events can be favorable and unfavorable. Accordingly, an entity should report both favorable as well as unfavorable events after the reporting period. Date when financial statements are approved is the date when board of directors approve the financial statements. In some cases, shareholders approval or supervisory board approval is needed for approval of financial statements after the approval of board of directors. Yet, for the purpose of deciding the event after the reporting period, the date of approval will be considered as the date of approval by board of directors only. So finally, board of directors approval will only be considered as date when financial statements are approved. Next, when the date of approval is after the public announcement of some other financial information. Events after the reporting period includes all events up to the date when the financial statements are approved for issue, even if those events occur after the public announcement of a profit or other selected financial information. So events up to the date of approval of financial statements are only considered under Ind AS 10. Other events occurred after approval of financial statements will not be considered. Next, type of events. Events are of two types: existing events, non-existing events. Existing events are the events which provide evidence of conditions that existed at the end of the reporting period. Non-existing events are events that indicate conditions that arose after the reporting period. In case of existing events, adjust the amount recognized in financial statements. In addition to this, also make separate disclosures for the same. In case of non-existing events, don't adjust the amount in the financial statements, but if the non-existing event is material, then disclose in financial statements, that is notes to accounts. Examples of existing events: settlement of court case after balance sheet date that confirms obligation existing at the end of the reporting period. Second one, the receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period, or that the amount of the previously recognized impairment loss for that asset need to be adjusted. Next, sale of inventory after the year end but before the financial statements are approved gives evidence about the NRV at the end of the reporting period. In some cases, assets which are purchased are sold before the end of the reporting period. Actual amount paid or received is determined after the end of the reporting period. For example, the sale of an asset took place in March 2022. However, the actual consideration was determined and collected after 31st March 2022. That is on 10th May 2022. The date of approval of financial statements was 15th May 2022. In such a situation, sale value recognized in the books as on 31st March 2022 need to be adjusted. Next, if any error or fraud is detected after the reporting period, which is related to reporting period. These are the examples of adjusting events. Next, examples of non-adjusting events. A decline in fair value of investments between the end of the reporting period and the date when financial statements are approved for issue, where the decline does not relate to the condition of investments at the end of the reporting period. Second example is a major business combination occurred after the end of the reporting period, for which the agreement was also entered after the end of reporting period. Then it will be non-adjusting event. If agreement and not meeting and negotiations was entered before the end of the reporting period and business combination was completed after the reporting period, then it would be an adjusting event. If agreement is occurred, it will be an adjusting event. If agreement is not occurred, then it will be a non-adjusting event. Meetings, negotiations does not matter. Next, destruction of major production plant by a fire after the reporting period, it is a non-adjusting event. Changes in tax rates after the reporting period, it is a non-adjusting event. Next, commencing major litigation arising solely out of the events that occurred after the reporting period, it is a non-adjusting event. Abnormal Abnormally large changes in asset prices or foreign exchange rates after the reporting period, it is also a non-adjusting event. Special cases, dividend. Generally, dividend declared after balance sheet will be a non-adjusting event. If dividend is declared after the end of the reporting period, but before the approval of financial statements, then the dividends are not recognized as liability at the end of the reporting period because no obligation exists at the time of balance sheet date. That means the reporting period date. Such dividends are disclosed in notes to accounts only. So dividends declared after balance sheet date is a non-adjusting event. It will be disclosed in notes to accounts only. Next, going concern. If after the end of the reporting period, but before the financial statements are approved, there are signs of entities liquidating the business or a major incident has occurred and it affects our going concern assumption. Affects our going concern assumption, then the financial statements relating to the reporting period should not be prepared on going concern basis and it should be prepared with a different approach, that is liquidation basis. Example, when going concern assumption is not valid, all long-term liabilities will turn into short-term liabilities. Raw materials and work in progress will be valued at a market price or scrap value. Also, as per Ind AS 1, if financial statements are not prepared on the basis of going concern assumption, then disclose the same in the notes to accounts. So the crux regarding going concern is, if going concern is affected after balance sheet date but before financial statements approval, it is an adjusting event. Financial statements need to be prepared on liquidation or realization basis. Another important point is, if inventory NRV falls after balance sheet date, it will be an adjusting event. It needs adjustment in the financials. Next, long-term loan arrangement. It is a carve out to International Accounting Standards 10, where there is a breach of a material provision of the long-term loan arrangement on or before the end of the reporting period, with the effect that liability becomes payable on demand on the reporting date. The agreement by lender after the end of reporting date but before the approval of financial statements to not demand payment as a consequence of the breach should be considered as adjusting event. However, under International Accounting Standards 10, events after the reporting period, an agreement with the lender after the reporting period but before the approval of the financial statements for issue not to demand payment, say arising out of breach of loan covenants, is not considered as an adjusting event. The crux is, after balance sheet date, if any breach of long-term arrangement occurs, after breach, if grace period of greater than equals to 12 months is given or conditions removed in any of the case, that means grace period greater than equals to 12 months are given or conditions removed, it will be an adjusting event. It needs adjustment in the financials. This facility is not there in International Accounting Standard 10. As per IAS 10, it will still be considered as non-adjusting event only. So after breach, if grace period greater than equals to 12 months is permitted or conditions removed, it will be an adjusting event. Next, distribution of dividend to owner in non-cash form. When an entity declares a distribution of dividend and has an obligation to distribute the assets concerned to its owners, it may recognize a liability for the dividend payable. Measurement of dividend payable. There are two cases, case number A, case number B. Case number A, if non-cash assets are distributed, measure the liability of dividend payable at the fair value of the assets to be distributed. Case number B, if entity gives its owner choice of receiving either a non-cash asset or a cash alternative, estimate the liability of dividend payable by considering the fair value of each alternative and probability of owners selecting each alternative. At the end of each reporting period and at the date of settlement, review and adjust the carrying amount of dividend payable based on changes in fair value of the assets to be distributed, with any changes in the carrying amount of the dividend payable recognized in other equity as adjustments to the amount of the distribution. When an entity settles the dividend payable, it shall recognize the difference, if any, between the carrying amount of the asset distributed and the carrying amount of the dividend payable in profit or loss. For example, an entity decides to give a property, plant, and equipment to the owners as dividend. Dividend declared on 1st February 2017, dividend paid on 1st May 2017. On 1st February 2017, assets carrying amount is 1 lakh. Assets fair value is 1 lakh 20,000. On 31st March 2017, assets fair value is 1 lakh 30. It has increased by 10,000. Next, on 1st May 2017, assets fair value is 1 lakh 50. fair value increased by 20,000. Next, so the treatment of dividend payable is on 1st February 2017, dividend is declared. The entry will be reserves and surplus other equity account debit to dividend payable 1 lakh 20 recognized at fair value. On 31st March 2017, assets fair value increased by 10,000. The entry will be reserves and surplus other equity account debit to dividend payable account 10,000. Next, on 1st May 2017, assets fair value again increased by 20,000. Entry will be reserves and surplus other equity account debit to dividend payable account 20,000. Assume on, not an assumption, in the question it is given that dividend paid on 1st May 2017. In such a case, the entry will be dividend payable account debit 1 lakh 50. It is the assets fair value to PPE 1 lakh. Assets carrying amount is 1 lakh and to PNL 50,000. PNL 50,000. Some important points to be discussed. First case, if inventory is NRV falls after balance sheet date, if condition exists as on balance sheet date, it will be an adjusting event. If there is no condition and NRV changes due to price change in the market, it will be an adjusting event. There is no condition and NRV changes due to water leakage or fire damage, it is a non-adjusting event. It does not require any adjustments. Next, robbery. Robbery occurred. It is an adjusting event. Rocky surface. Rocky surface found. It is an adjusting event. Debtors became insolvent after financial statements approval date. After financial statements approval date, Ind AS 10 is not applicable. Debtors became insolvent after balance sheet date, before approval of financial statements date, it will be an adjusting event. Next, trade discount. Trade discount is generally deducted from sales. Cash discount. Cash discount means a price discount. It is shown as expenditure separately. Date of commencement of depreciation. Depreciation shall start from the year of asset available for use. No put to use concept here. Here depreciation will commence from the year asset is available for use.